We all see those investment returns, the big, bold numbers promising growth. But if you ever stop to think about what's really behind those figures?
Yeah, like how much risk was involved.
Exactly. Or could someone else have done even better with less drama? It's a question many of us have, and today on the Deep Dive, we're tackling it head on.
We want you to feel confident, not overwhelmed.
That's right. So we're going to unpack the core concepts of portfolio performance measurement and evaluation. We're drawing on a comprehensive chapter to guide us.
Our goal is pretty simple, really.
We want to give you the smart shortcuts to understanding how to truly judge investment performance, looking at both the gains and the potential pains along the way.
That's right. It's human nature to focus on the reward, the return.
Definitely.
But as our source material highlights, a 20% gain achieved by, betting the house on a single volatile stock is a very different beast.
Mm-hmm.
From a similar return earned through a well-thought-out, diversified strategy.
Completely different stories.
So this deep dive will equip you with the critical thinking skills to move beyond those surface-level numbers and understand the true story of your investments.
Okay, so the chapter kicks things off with a fundamental truth. You can't talk about how well an investment has done without also talking about the bumps in the road, the risk.
It's absolutely key.
It's like judging a tightrope walker solely on whether they reached the other side.
Right, without considering how high the wire was.
Or if there was a safety net.
Yeah.
The context of risk is absolutely crucial in the investment world.
Precisely. A seemingly impressive return might not look so hot when you realize the investor took on an enormous amount of risk to get there.
That makes sense.
Understanding that risk-return relationship is, well, it's the bedrock of sound investment evaluation.
So how do we even begin to put numbers on these returns? Our guide walks us through several ways to calculate the holding period return, or HPR.
HPR, got it.
Think of it as the return on your money from the time you invested until now, a basic point-to-point measure.
The simplest form.
Yeah. The formula is pretty straightforward. Ending value, beginning value, beginning value.
Okay.
They give us a quick example. If you started with Rs 1,000,000 and it grew to Rs 1,020,000, that's a 20% HPR. Simple enough, right?
It's the most fundamental way to look at a return over a specific period, yeah. And it's definitely a common starting point.
Good.
However, as the chapter points out, this basic calculation misses a key piece of the puzzle.
Right.
Any income you might have received during that time.
Right, like dividends or interest.
Exactly.
So they give us a more complete formula. Income plus ending value, beginning value.
Okay, adding in the income.
Using that same example, if you also received Rs 5,000 in income, your HPR actually jumps to 25%.
Ah, so that income boost.
Yeah, that income definitely adds to the overall picture. But as the chapter wisely notes, this still makes a simplifying assumption that all that income arrives at the very end of the year.
Which might not be reality, but it's a practical simplification for many basic analyses.
Right, like if you're looking at a year-end statement.
Yeah, this gives you a good snapshot of the total growth and income generated during that period.
Now, things get a bit more interesting when we're looking at investments over multiple years.
Okay.
Especially if we're regularly adding or taking out money.
Ah, the cash flow problem.
This is where we need to understand the difference between the time-weighted rate of return, TWRR, and the money-weighted rate of return, MWRR.
TWRR versus MWRR. Important distinction.
To illustrate, the chapter gives us a 5-year period with some up and down annual returns from a negative 5% year to a whopping plus 30% year.
Quite a ride.
And they also show how the amount invested at the beginning of each year changed, ranging from Rs 5,000 to Rs 25,000.
So different amounts going in at different times.
Eventually ending with a portfolio worth Rs 105,920.31.
Okay, this scenario really highlights how the timing of when you put money in or take it out can influence your overall experience.
Definitely.
MWRR, which is essentially the internal rate of return, or IR.
IR, right. Heard of that.
It takes all those cash flows into account. It tells you the rate at which your total invested money grew over that whole period, considering when each contribution was made.
So it's your specific return.
Exactly. In this example, they've calculated an IRR, or MWRR, of 15.15%.
15.15%. Okay, so if you were the investor in this case, the MWRR of 15.15% is the actual return you felt on your deposited money, considering all those different investment amounts and their timing.
Precisely. It directly answers the question, what was the growth rate of the specific amounts of money I put in, considering when I put them in? However, this measure can be heavily swayed by those cash flow decisions, which aren't necessarily a reflection of the underlying skill of whoever is managing the investments.
Oh, okay. And that's where TWRR steps in, right?
Exactly.
The chapter explains that TWRR is designed to filter out the impact of those external cash flow decisions and focus purely on how the investments themselves performed.
Exactly. To calculate TWRR, you essentially hit pause every time there's an external cash flow when money comes in or goes out.
Like stopping the clock.
You figure out the return for each of those mini periods and then link those returns together to get the overall performance.
Linking the sub-periods.
It's like evaluating a chef by tasting their dishes individually, regardless of how many guests showed up for dinner.
Nice analogy. They walk us through this using something called wealth relative.
Wealth relatives, yes.
Which are basically just the growth factor for each of those mini periods, 1 plus the return.
Mm-hmm.
You then multiply all those growth factors together to get the total growth over the entire time. In this example, that total growth factor, or cumulative wealth relative, is 1.3396 over those 5 years.
And to get that back into an annualized return, you take that total growth factor, raise it to the power of 1 divided by the number of years, so in this case to the power of 15, and then subtract 1.
Okay, a bit of math there.
And that gives us a TWRR of 6.021%.
6.021%.
The chapter also points out that this TWRR is the same as the geometric return we'll discuss shortly.
Okay, good link. It's fascinating to see such a big difference between that MWRR of 15.15% and the TWRR of 6.021% in this example.
Huge difference.
It really shows how those varying investment amounts can skew your perception of how the underlying investments are actually doing.
Absolutely.
The chapter even mentions that SEBI, the regulatory body, requires portfolio managers to report their performance using TWRR for the last 3 years.
Right, and that regulatory requirement underscores the importance of TWRR as a standardized way to evaluate the skill of the investment manager, independent of the client's deposit and withdrawal decisions. It allows for a more fair comparison between different managers.
Makes sense for comparing managers.
However, as the chapter correctly points out, for you as an individual investor, the MWRR often feels more relevant.
Feels more relevant. How so?
Because it reflects the actual return on the money you put in and ultimately what you take out. It's your personal experience.
Ah, I see. The what I actually got number. Okay. Let's move on to another really important distinction. The geometric mean return, GMR, versus the arithmetic mean return, AMR.
GMR versus AMR, also crucial.
The chapter uses a brilliant example here with 2 different investment schemes over 2 years. Scheme 1 takes a nosedive of mitigate 50% in year 1.
Ouch.
And then skyrockets by plus 100% in year 2.
Roller coaster.
Scheme 2 has a more consistent growth of plus 10% in both years.
Steady Eddie.
And the end results are quite eye-opening. Despite Scheme 1 having a simple average, or arithmetic mean, return of 25%.
Yeah.
Well, netting 50 plus 102.
Yeah, the simple average looks good.
If you started with R's 100,000, you end up right back at R's 100,000 after those 2 years.
Flat, despite that 25% average.
Crazy, right? Scheme 2, on the other hand, with a lower arithmetic average of 10%, 10 plus 10, 2.
Lower
It
average.
actually grows your initial R's, 100,000 R's, 121,000.
So the steadier one ended up much better.
It's a powerful illustration of why just averaging returns can be misleading, especially when you have those big swings.
Volatility really matters for compounding.
The chapter defines AMR as that simple average of yearly returns and says it's actually the best guess for what you might expect in a single future year based on past performance.
That's a key statistical point. If you were to randomly pick any single year in the future and you only had the past returns to go on, the arithmetic mean would be your best unbiased estimate of what that single year's return might be.
Okay, so it has its place for forecasting 1 year.
Yes, statistically.
But when we want to see how our investments actually grow over the long haul, that's where the geometric mean return comes into play.
GMR for long-term growth.
The chapter explains that GMR is the compound annual return, and it only cares about where you started and where you ended, not the roller coaster ride in between.
Captures the compounding effect.
Using the formulas, the GMR for Scheme 1 is 0%.
Which makes sense. You ended where you started.
Which perfectly reflects that you ended up with the same amount you started with. For Scheme 2, the GMR is 10%, matching its consistent annual growth.
Again, reflects the actual outcome.
This really shows what actually happened to your money over time.
Exactly. The geometric mean gives you a much clearer picture of the actual long-term growth rate of your investment. It takes into account the compounding effect and is essential for understanding how your wealth has actually accumulated over time.
Very important.
The chapter also correctly notes that if you're only looking at 1 year, the AMR and GMR will be identical.
Okay, for 1 year they match.
However, over longer periods, the GMR will almost always be lower than the AMR.
Willer, why is that?
Unless every single year's return was exactly the same. The bigger the swings in returns, the bigger the difference between the two. Volatility drags down the compound return.
Got it. Volatility hurts the GMR more. Okay, our deep dive then steers us into the difference between gross versus net return.
Fees. Always look at the fees.
Gross return is the return your investments make before any fees or expenses are taken out, while net return is what's left after those deductions.
Net is what you actually keep.
They give us a really detailed example with a hypothetical portfolio and various fees, showing how a seemingly healthy 20% gross return
20% looks great.
can shrink down to a less impressive 13.88% net return.
Oof, that's a big chunk gone.
It really hammers home how important it is for us as investors to look beyond the initial rosy numbers.
Those fees, whether they're for managing the fund, for trading, or even for taking your money out, they can eat significantly into your overall returns.
So always check the net.
Always pay close attention to the net return. That's the real performance that matters to you.
Next up is the concept of pre-tax versus post-tax return.
Taxes, the other certainty.
The chapter explains that while investment performance is usually quoted on a pre-tax basis.
Makes comparison easier.
Right, which makes it easier to compare different investments and strategies. What ultimately lands in our bank accounts is the post-tax return.
What you actually get to spend.
Since everyone's tax situation is different, the pre-tax number is more of a universal benchmark.
Understandable.
They provide the formulas for converting between the two and illustrate with an example showing how a 5% pre-tax return can become just 4.25% after a 15% capital gains tax.
Another significant haircut. It's a crucial reminder that the headline return isn't the whole story. Your individual tax bracket will have a direct impact on your real investment outcome.
So, pre-tax for comparing, post-tax for planning.
While pre-tax returns are useful for comparison, always keep in mind what you'll actually net after Uncle Sam takes a share.
We then delve into the compounded annual growth rate,
Key GAGR.
often quoted.
Which, as the chapter clarifies, is essentially a smoothed-out annual growth rate, assuming that any profits or income are reinvested.
Smooths out the ups and downs.
They provide the formula and then revisit that earlier 5-year return example to show how the initial investment grew to that final value, resulting in a KGR of 6.02%.
The same as the TWRR we saw earlier.
Ah, yes. Think of it as a way to see the steady annual growth needed to get from the start to the finish line over that period. KEGR is a useful metric for understanding the long-term, consistent growth rate of an investment, smoothing out those year-to-year fluctuations.
Closely linked to KGR is the idea of annualizing return.
Making things comparable.
The chapter points out that this is done to make it easier to compare investments that have been held for different lengths of time.
Like a 6-month return versus a 3-year return.
Exactly.
Yeah.
And the calculation is essentially the same as finding the KGR or the geometric mean return.
Same underlying math.
They walk through another example with returns over 3 years, showing the steps to calculate that compounded annualized return.
Annualizing allows you to put returns on a level playing field, so you can directly compare the performance of an investment held for, say, 3 years with one held for just 1 year.
Got it. A really interesting point our deep dive brings up is the idea of cash drag adjusted return.
Ooh, cash drag. That's subtle but important.
This highlights that if a fund manager doesn't invest all the money they're managing, if they keep a significant portion in cash, that cash can actually pull down the overall return of the portfolio.
Because cash usually earns very little.
Right. They use an example where only 75% of the money is invested in equities earning 10%, while the other 25% is in low-yielding liquid funds earning only 4%.
Okay.
The adjusted return of 8.5% is lower than the 10% the invested portion made.
Lower overall.
Clearly showing the drag caused by holding cash.
This is a really important point for understanding the true efficiency of a fund manager. While holding cash can sometimes be a strategic decision.
Sure, sometimes it's deliberate.
A consistently high cash balance can indeed dampen overall returns for the investor. Fund managers typically report on the entire portfolio, so this cash drag effect is reflected in the overall numbers.
Good to be aware of. Of course, no discussion of performance would be complete without tackling alpha and beta return.
Ah, the Greek letters of finance.
This gets into the world of asset pricing models like CAPM,
Capital Asset Pricing Model.
which helps us understand how much return we should expect for taking on a certain level of risk.
Expected return based on risk.
Beta measures the systematic risk, the risk that affects the whole market and can't be diversified away.
Market risk.
While alpha is the extra return you get above and beyond what would be expected for the level of risk you took.
The skill components, supposedly.
They walk through an example showing how a portfolio's 25% return can be broken down based on the market's performance and the portfolio's beta.
Alpha is often seen as a measure of a fund manager's skill, their ability to generate returns that aren't just due to broad market movements.
So positive alpha is good.
Generally, yes. Beta, on the other hand, tells you how sensitive your portfolio is to the overall market.
How much it moves with the market.
It's worth noting, as the chapter does, that some people simply define alpha as the return your portfolio achieved above its relevant benchmark. A simpler definition.
Okay, just outperformance versus benchmark.
Yeah, sometimes it's used that way too.
Finally, in our exploration of return measures, we have the simple concept of portfolio return itself,
how the whole thing performed,
which the chapter clearly states is just the weighted average of the returns of all the individual investments within that portfolio.
Weighted average makes sense.
They provide a quick example showing how to calculate this based on the holdings and their individual performances.
Understanding how the returns of individual holdings contribute to the overall portfolio return is fundamental for analyzing performance and making decisions about asset allocation.
Like how you spread your money around.
Exactly. How you spread your money across different investments.
All right, so we've got a pretty good handle on the different ways to measure returns. A lot of them.
A whole toolkit.
But, as we said right at the beginning, that's only one side of the coin. Now we need to dive into the world of risk measures.
The other, equally important side.
The chapter emphasizes that you absolutely cannot talk about performance without also talking about the level of risk that was taken to achieve it.
Exactly. Think of it like this. 2 climbers might reach the same summit, but one might have taken a much more dangerous route than the other.
Good analogy.
Looking at the outcome alone doesn't tell the whole story.
So the chapter starts by differentiating between total risk and downside risk.
Okay, 2 types.
Total risk is basically the overall uncertainty or variability in expected returns.
It's general wobbliness.
While downside risk specifically focuses on the possibility of actually losing money.
The risk of things going south.
They mention variance and standard deviation as ways to measure total risk.
Standard deviation is the common one.
And semi-variance or semi-standard deviation for looking at just the downside.
Focusing on the negative volatility. These are all statistical tools to help quantify how much an investment's returns tend to fluctuate. Standard deviation in particular is a very common measure of that overall volatility.
We then get an important reminder about portfolio risk versus individual risk.
Ah, diversification benefits.
It's not as simple as just averaging out the risks of the individual stocks or bonds in your portfolio.
Not usually, no.
The chapter highlights the crucial role of correlation, how different investments move in relation to each other.
How they dance together or don't.
If you have investments that don't move in lockstep, you can actually reduce the overall risk of your portfolio.
Smoother ride.
That's the power of diversification at work.
Precisely. By combining assets that don't always zig and zag at the same time, you can smooth out the overall ride of your portfolio and potentially reduce the big ups and downs.
Makes sense. Next, we look at market risk.
The big picture risk.
Which are those big swings caused by factors that affect the entire market, like economic recessions or interest rate changes.
Stuff you can't avoid just by owning different stocks.
The chapter tells us that this type of risk is measured by beta.
Beta again.
And importantly, you can't diversify it away completely, although you can hedge against it.
Market risk is the inherent risk you take just by participating in the broader market. While diversification helps with individual stock-specific risks, you're still exposed to these larger market-wide movements.
Okay, let's delve a bit more into understanding volatility. The chapter focuses on standard deviation as a key measure.
The workhorse measure of total risk?
It's basically a way to see how spread out the returns of an investment have been around its average return.
How much they jump around the average.
A higher standard deviation means the returns have been more volatile, jumping around more, which is generally seen as higher risk.
Higher number, more volatile, generally riskier.
It's a widely used tool in finance and even in other fields.
Just see it everywhere.
Comparing the riskiness of different things.
Its strength is that it gives you a single, easy-to-understand number that represents the overall level of volatility. You can use it to compare different investments or even different portfolios with similar goals.
Okay. Then we have semi-variance and semi-standard deviation.
Focusing on the downside again.
Which, as we mentioned earlier, zoom in specifically on the volatility of returns that fall below the average, that downside risk we were talking about.
Just measuring the bad fluctuations.
Target semi-variance even looks at returns that fall below a specific target you might have set.
Like returns below zero, perhaps?
While this seems really relevant to what most people worry about losing money.
Intuitively appealing.
Right. The chapter notes that it's not as widely used in practice, partly because it can be tricky to accurately predict these types of asymmetrical returns.
Yeah, while intuitively appealing, especially to those who are very risk-averse. The practical challenges in reliably measuring and forecasting downside risk have limited the widespread adoption of these measures. Standard deviation is just easier.
Okay, so standard deviation is more common. Another important risk measure is tracking error.
Tracking error, how much you stray from the benchmark.
This tells us how closely a portfolio's returns have followed the returns of its benchmark, usually a market index.
Active versus passive difference.
It's calculated as the standard deviation of the difference between the portfolio's returns and the benchmark's returns.
The volatility of the outperformance or underperformance.
A low tracking error means the portfolio has stayed very close to its benchmark.
Like an index fund would aim for?
The chapter clarifies that this is usually calculated against a total returns index, which includes dividends.
Important detail. Include those dividends.
Tracking error happens when a portfolio's risk profile isn't perfectly aligned with its benchmark. They also briefly mentioned tracking difference.
Tracking difference.
Which is just the simple difference in returns over a period. Point-to-point difference.
Simpler. Tracking error is particularly important for investors who are aiming to mirror the performance of a specific market index. A high tracking error suggests that the portfolio manager's active decisions are leading to significant deviations from that benchmark.
Got it. We then circle back to systematic risk and unsystematic risk.
Market risk versus specific risk.
Just to reiterate that systematic risk, the market-wide stuff, can't be diversified away and is measured by beta.
Beta measures market risk.
While unsystematic risk, the company-specific stuff, can be reduced by holding a diverse range of investments.
Diversification helps here.
And alpha is the potential reward for bearing any remaining unsystematic risk.
This is a core principle of investing. Diversification is your primary tool for managing those company-specific risks.
Speaking of beta,
the sensitivity measure.
The chapter explains it as a measure of how sensitive a stock or a portfolio's returns are to the movements of the overall market. A beta of 1 means it tends to move in line with the market.
Moves with the market.
A beta greater than 1 means it's more volatile than the market.
More jumpy.
And a beta less than 1 means it's less volatile.
More stable, relatively.
Crucially, they show how to calculate a portfolio's beta by taking the weighted average of the betas of all the individual investments in it.
Weighted average of the parts.
So if you have a portfolio that's 60% and a stock with a beta of 1.2 and 40% and a stock with a beta of 1.1, your overall portfolio beta would be 1.16.
Okay, so slightly more volatile than the market overall. Beta gives you a good sense of your portfolio's overall market exposure.
How exposed you are.
If you're expecting a bull market, you might be comfortable with a higher beta. If you're anticipating a downturn, you might prefer a lower beta.
Makes sense. Our rundown of risk measures concludes with a quick look at liquidity risk.
Can you sell it quickly?
Which is the risk of not being able to sell an asset quickly at a fair price.
Like trying to sell a weird piece of art fast.
And credit risk.
Well, they pay you back.
Which is the risk that someone you've lent money to might not pay it back.
These are important considerations depending on the types of assets you're investing in. For example, fine art might have higher liquidity risk than a widely traded stock.
Sure.
And corporate bonds carry credit risk that government bonds typically don't.
Okay, so now we have a toolbox for measuring both the returns and the risks of our investments. Feels like we've covered a lot.
We have. Returns and risks measured.
But the real insight comes when we put them together and look at risk-adjusted return measures.
Getting bang for your risk buck.
These help us see how much return we're getting for the amount of risk we're taking.
Exactly. It's about that trade-off. Are you being adequately compensated for the level of risk you're assuming?
The chapter introduces several key ratios here. First is the Sharpe ratio.
The famous Sharpe ratio.
Which looks at the excess return you've earned above a risk-free rate, like a government bond.
Return above safety.
For each unit of total risk, as measured by standard deviation, you took.
Divided by total risk, reward to variability.
They give the formula and an example, highlighting that a higher Sharpe ratio generally means better risk-adjusted performance.
Higher is better.
When you're comparing investments that are mutually exclusive.
Like picking one fund over another.
However, they also point out that because it uses total risk, it might not fully reflect the benefits of diversification in a larger portfolio.
Doesn't distinguish between good volatility and bad, or diversifiable risk. Still, the Sharpe ratio is a very popular and widely used metric because it's relatively simple to calculate and provides a good overall picture of risk-adjusted performance. It's a good way to compare, say, two different mutual funds with similar investment objectives.
Okay, so widely used. Next up is the Trainer ratio.
Trainer. Similar but different denominator.
Which is similar to the Sharpe ratio, but instead of using total risk, it uses systematic risk, beta, in the denominator.
Uses beta instead of standard deviation.
Again, they provide the formula and an example, noting that a higher Trainer ratio is generally preferred.
Higher Trainer also better.
This measure is particularly useful when you're evaluating a single investment within a well-diversified portfolio.
Right, because if you're already diversified, you mainly care about the systematic risk contribution. Because the Trainer ratio focuses only on systematic risk, it's a more appropriate measure for investors who have already taken steps to diversify away most of their unsystematic risk. It tells you how much excess return you're generating for the market risk you're taking.
So, Sharpe for overall Trainer if you're diversified. The chapter then directly compares the Sharpe versus Trainer measure.
Head to head.
Summarizing that Sharpe uses that total risk picture, while Trainer focuses just on the market-related risk.
Total risk versus systematic risk.
They make the point that if you have a perfectly diversified portfolio, the two should give you similar rankings.
If rankings differ.
If the rankings differ, it might suggest differences in how well diversified the portfolios are.
Interesting diagnostic.
The takeaway is that Sharpe might be more useful for investors with less diversified holdings, while Trainer is better for those who are already well diversified.
That's a really important distinction for choosing which measure is most relevant to your situation. Think about the scope of your overall investment strategy.
Good practical advice. We then encounter the Sortino ratio.
Sortino. Back to downside risk.
Which is like the Sharpe ratio.
Yeah.
But it uses semi-standard deviation, that measure of just the downside volatility in the denominator.
Excess return divided by downside deviation.
This makes it potentially more interesting to investors who are particularly concerned about avoiding losses.
Focuses on the bad volatility.
A higher Sortino ratio is also seen as better.
By focusing specifically on the volatility of negative returns, the Sortino ratio can give a more nuanced view of risk-adjusted performance for investors who are more sensitive to downside risk than to upside volatility.
Makes sense for risk-averse folks. Then, the information ratio, sometimes called the appraisal ratio.
Information ratio, measuring active skill.
Looks at how much extra return a portfolio has generated compared to its benchmark.
That's the active return.
Relative to how consistently it has deviated from that benchmark. That's the tracking error we talked about.
Divided by the active risk or tracking error.
The chapter explains that it helps you assess if any outperformance is likely due to genuine skill or just random chance.
Skill versus luck, basically. The information ratio is a key metric for evaluating the consistency and skill of an active fund manager. A higher ratio suggests that the manager is consistently adding value relative to their benchmark without taking on excessive tracking risk.
Okay, consistency of alpha. Finally, in our exploration of risk-adjusted returns, we have the Modigliani and Modigliani ratio, or M2 measure.
M squared. A bit different, this one.
This one takes a bit of a different approach. It essentially adjusts the risk of the portfolio to match the risk of the market benchmark.
Levels the playing field on risk.
By hypothetically leveraging or deleveraging the portfolio.
Using borrowing or cash.
And then compares the return of this risk-adjusted portfolio to the actual market return.
Compares returns at the same risk level as the market.
The example they provide shows how this can reveal underperformance even if the initial unadjusted return looks pretty good.
The M2 ratio provides a really intuitive way to compare a portfolio's performance directly to the market on a risk-adjusted basis. It answers the question, if this portfolio had taken on the same level of risk as the market, how would its return stack up?
Very clever. Now that we have all these tools for measuring and adjusting returns for risk, how do we actually use them to evaluate performance in the real world?
Putting it all together.
The chapter tells us that performance evaluation is fundamentally about comparison.
Can't judge in a vacuum.
This brings us to the essential concepts of benchmarking and peer group analysis.
Benchmarks and peers. Your comparison points. Without a relevant point of comparison, it's very difficult to determine whether a particular investment performance is good, bad, or just average for the level of risk that was taken.
Makes sense. The chapter stresses the importance of selecting appropriate indices for benchmarking.
Choosing the right yardstick.
And even outlines the key characteristics of a good benchmark, drawing from the GIPS standard.
Yay.
Global Investment Performance Standards. These characteristics include being clearly defined, investable.
You have to be able to actually invest in it.
Consistent with the portfolio's investment approach and risk-return profile, and having measurable performance.
A well-chosen benchmark acts as an objective yardstick against which you can measure the success of an investment strategy and determine if a manager is indeed adding value.
It adds value beyond just tracking an index, yeah.
Yeah.
However, the chapter points out that sometimes standard market indices just don't quite fit the bill.
One size doesn't always fit all.
And that's where customized benchmarks can come in.
Tailor-made benchmarks.
They explain how a portfolio manager's specific investment universe might serve as a more relevant benchmark.
More specific comparison.
While this can be more accurate, the chapter also notes potential downsides, like increased cost.
It can be expensive to create and maintain.
It's interesting to see how index providers are now offering more tailored benchmark options.
Customized benchmarks can provide a more precise comparison for niche or highly specialized investment strategies, but they do introduce complexities and can be more expensive to construct and maintain.
Of course, the chapter also cautions us about common benchmarking errors.
Pitfalls to avoid.
Like choosing a benchmark that doesn't really represent the investment strategy.
Apples and oranges comparison.
Failing to update the benchmark when the strategy changes. Using a benchmark you can't actually invest in.
That's a big one.
Or relying on benchmarks with shaky data, especially for total return.
Bad data in, bad conclusions out. These errors can lead to completely misleading conclusions about performance. It's crucial to be thoughtful and diligent in selecting and monitoring your benchmarks.
Diligence is key. Finally, in the realm of performance evaluation, we have manager's universe analysis, or looking at peer groups.
Comparing against the competition.
This involves comparing a portfolio's performance to the median or average performance of a group of similar investments.
How did you do versus similar funds?
The chapter mentions how natural it is for investors to want to see how their investments stack up against others.
We all want to.
And notes the role of firms that track this data and provide rankings based on risk-adjusted returns.
Peer group analysis provides valuable context by showing how a particular investment has performed relative to its competitors with similar strategies and risk profiles. It can help you see if your fund is a leader, a laggard, or somewhere in the middle.
Leader or laggard. Good way to put it. So we've measured and we've compared. Now the final piece of the puzzle is performance attribution analysis.
Getting under the hood. Why did it perform that way?
This is all about figuring out why a portfolio performed the way it did. The chapter explains that it's about breaking down the total return into the return you would have gotten just by following the benchmark.
The benchmark return.
And the extra return, or shortfall, the differential return, and then trying to understand if that difference was due to skill or just luck.
Deconstructing the outperformance. Performance attribution helps you dissect the drivers of a portfolio's success or failure relative to its benchmark. It answers the question, what specific decisions contributed to the outperformance or underperformance?
Okay, what decisions mattered? The chapter highlights assets and sector allocation as a key factor.
Big picture calls.
If a manager decided to put more money into sectors or asset classes that did really well compared to the benchmark, or less money into those that did poorly,
being in the right place,
that would contribute to the differential return. That's the allocation effect.
Strategic decisions about way to allocate capital across different parts of the market are a primary way for active managers to try and add value.
Makes sense. Another crucial aspect is selection.
Picking the winners or avoiding losers.
The actual skill of picking individual stocks or bonds within those chosen sectors or asset classes that outperform their peers in the benchmark.
Finding the gems.
Or avoiding the ones that underperform.
Skillful security selection, picking the right individual investments, is another vital ingredient in potential outperformance.
So allocation and selection. The chapter then briefly touches on the ongoing debate between market timing versus selectivity.
Timing the market versus picking stocks.
Market timing is trying to predict when the overall market will go up or down, while selectivity is about picking the best individual investments.
The age-old debate.
It notes that most research suggests that consistently picking good investments is a more reliable way to outperform than trying to time the market's ups and downs.
Successfully timing the market consistently is incredibly difficult. Most evidence suggests that focusing on solid security selection and long-term asset allocation is a more sustainable path to investment success.
Focus on what you can control, maybe. We also get a mention of net selectivity,
Thomas measure,
which is presented as a more absolute way to measure performance, trying to isolate the excess return a manager achieved beyond what they could have gotten just by investing in the broad market portfolio.
Net selectivity attempts to provide a purer measure of a manager's stock-picking ability, adjusted for the overall level of market risk.
Okay, a purer measure of selection skill. And finally, for those of us investing across borders,
International investing adds another layer.
the chapter discusses the impact of local currency versus foreign currency denominated investment return.
Currency swings matter.
It gives a clear example showing how changes in exchange rates can significantly affect the returns you see once those foreign investments are converted back into your local currency.
Rupee versus dollar example.
Introducing the idea of currency risk.
For international investments, currency fluctuations can be a major factor in your overall return, sometimes even more significant than the performance of the underlying investments themselves.
Wow, that was an incredibly deep dive into the world of performance measurement. We've covered so much ground.
Definitely covered a lot.
From understanding why we need to look beyond simple returns to exploring a whole range of return calculations, risk measures, and those all-important risk-adjusted return metrics.
The whole toolkit.
We also touched on the critical steps of benchmarking and figuring out what actually drove performance through attribution.
It truly is a comprehensive framework for understanding how to evaluate investments. By considering all these different angles, you can move far beyond just looking at a bottom line number.
Beyond the headline number.
And develop a much more nuanced and informed perspective on how your money is working for you.
So as you reflect on all these different ways to analyze performance, how might you approach evaluating your own investments or the performance of a fund manager differently now?
Yeah, how has this changed your perspective?
Has your understanding of what truly constitutes good investment performance shifted?
Something to think about.
We hope this deep dive has given you a solid foundation to build upon, and remember, each of these areas offers pathways for further exploration. Thanks for joining us on the deep dive.